Welcome back. Major banks clearing the second round of the Federal Reserve stress test yesterday. It is the first time since the tests began back in 2011 that all 34 companies got passing grades from the Federal Reserve. That clears the way for U.S. banks to increase dividend payouts and buybacks. Joining us right now to talk more about it and the impact is Rafferty Capital Markets Equity Research Analyst Dick Bove. Dick, it's always a pleasure to see you. Thanks so much for joining us.
Thank you, Maria.
Your big takeaway from the stress test and the banks right now?
Well, I think you should be selling into this rally. I mean, I think that if I can let you think about this in a little bit different fashion, 6, 7 years ago, the government came along and told the banks they had to open up these huge reserves and put them on their balance sheet, and they told the banks they had to increase their capital. The reserves were never needed, so the banks have been eliminating the reserves, and of course they did increase the capital. So what happens if you get rid of the reserves? You put that money into the capital. So you find yourself with too much capital and you give the capital back. And that's what's happening at the present time. But if you take all this stuff away and you say, all right, forget the loan allowances, forget reserves, are these companies actually making any money? And the answer is they're not. I mean, basically, Goldman Sachs hasn't made any more money over the last, let's say, the whole time that Lloyd Blankfein has been there, they haven't increased their earnings. Wells Fargo hasn't increased its earnings for 5 years. U.S. Bancorp for the last 2, 3 years has not shown any increase in earnings. And then, in the next couple of weeks when they report their earnings, they're not going to be very good at all because loan volume is weak and trading is weak. So, what we're doing in the last day or last 24 hours is we're correcting an accounting error and giving the money back to investors. We're not doing anything which says, hey, these banks are making a lot more money.
Yeah, but I mean, do you expect that we're going to see increases in dividends? I mean, Bank of America announced plans to boost its dividends by 60% to 48 cents a share. Others as well. You saying sell into this rally, but do we have another leg of the rally when they start announcing dividend increases?
Well, they've announced them, right? And over the last 24 hours, every bank has run to, every bank press agent has run to the market and said, look, we're increasing our dividends, we're increasing our payouts, we're going to give you more money, we're going to give you 100% of the money that we earned in payouts, but they're not going to be able to do that next year or the year after that. In other words, they're correcting an imbalance. They're giving you money back as a result of this, putting too much money into the reserves over the last 5 or 6 years. But once they've given you that money back, if you want to keep increasing the dividends, you got to increase earnings, and they're not increasing earnings.
I see.
Dick, in terms of increasing earnings and, say, loan growth, for example, what does the economy look like to you that a healthy economy will benefit these financial institutions?
Yeah, well, in other words, that's a good one, because basically the banks are showing you that the economy is not showing any improvement whatsoever. In other words, 6, 12 months ago, you could expect to see commercial industrial loans rising on a year-over-year basis at 6 to 8%. Right now, they're struggling to not go down. In other words, actually last week they did go down a little bit. You'd expect to see, consumer loans booming here. But we're seeing a significant decrease in the demand for mortgages. We're seeing a decrease in the growth rate in credit card activity. We're seeing a decrease in the activity in the auto loan sector. The only sector of the bank lending area which is showing strength is, your non-residential construction, and that's down from double digits to 7.5%. 7.5% is very strong, but it's way down from where it had been. So right across the board, where banks make earnings, banks don't make earnings on interest rates. They make money by selling loans. Every one of the key areas that you would look at to say, are these guys making money? They're not. Now, if they're not making money, on loans, how can the economy be doing as strongly as people suspect? It isn't. So I think that, as I say, this is a good time to take a little profit out of these bank stocks.
Mm-hmm. Do you expect that policy coming out of Washington will accelerate the economy? I mean, the economy that you're telegraphing here is just moving at a snail's pace, which has been the case for the last, say 8 years.
Yeah, well, it certainly has been moving at a snail's pace in the last quarter, if the bank numbers are any good. But,
okay,
if we forget the bigger issue and just look at banks, which is all I'm interested in, you know, the Trump administration has done, in my view, magnificent things to assist the industry. I mean, basically, they're weakening the power of the Fed, increasing the power of the Financial Stability Oversight Council.
Right.
They put a banker in charge of the OCC. They put the guy who wrote the Financial Choice Act in front of the FDIC, and they've taken a guy who has been buying financial companies, and they want him to be the Fed governor in charge of bank regulation. There are 91 changes that they've suggested in bank regulations of the 370 that were put into effect in the last 7 or 8 years. I mean, the Trump administration has been magnificent for banks.
Now, let me ask you real quick before you go, Dick, because Warren Buffett is now on track to become Bank of America's biggest shareholder. This stock is up 40% since the election. Buffett says a larger dividend would lead Berkshire Hathaway to convert a stake in the bank into $17 billion worth of common stock. What would that move mean for Bank of America? And isn't it interesting that Buffett was the largest shareholder of Wells Fargo? Now, with all the stock he owns in B of A, he's going to be the largest shareholder there.
Yeah, I think there's a real question as to the legality, because it's not him, it's Berkshire Hathaway. And there's a real question to the legality of what his positions are. He is the biggest shareholder, or his organization is the biggest shareholder in the second and third largest banks in the United States. Plus, he has significant holdings of a bunch of other banks like BNY Mellon, Goldman Sachs, U.S. Bancorp. I mean, he has huge positions. And quite frankly, he's been a lousy investor in banks. In other words, he got out of SunTrust at the bottom, and he's stuck with a whole bunch of banks which are not showing any improvement in earnings. He totally missed, you know, what was going on at Wells Fargo, which is a major error if you are the largest shareholder in the company. So, I mean, you know, he got two sweetheart deals. He got a sweetheart deal on Goldman Sachs. He got a sweetheart deal on Bank of America. He made a fortune on them, but that didn't take any effort on his part. These companies begged him to be into these deals. Warren Buffett has not been a good investor in banks if we're trying to look at what his performance has been.
All right. Good to point out, Dick. Great to see you, sir. Thanks so much.
Thank you.
Dick Bove, Rafferty Capital Markets.